Hey guys, how are you? I hope all of you are doing really good. Welcome to KSJ Teaching. I'm your friend, your mentor, CS Saurav Jindal, welcoming you all to another session of Economics for Finance Excellency batch. Okay, so now we are going to start with the last unit of economics, that is international trade. Another very important part of economics, that how the countries trade with one another, right? So the first topic in that is the theories of international trade. The theories were given by different different people, different economists over the time, and they tell us, the various theories tell us that how the international trade is being conducted. Is being conducted means that what are the various bases on which the countries trade with one another. So international trade is when there is an exchange of goods and services across the boundaries of a nation, right? So with the different nation, the transactions between the different nations, that is what is known as international trade. Okay, so in this first part, we will try to understand what is our international trade, right? What are the various, what is international trade versus domestic trade? This is what we have to study. Then we will study about the arguments in favor of international trade, arguments against the international trade. All these things we are going to study in this particular lecture, right? After that, we'll move on to the theories of international trade. So first is, what is an international trade? International trade refers to exchange of goods, services and resources. Any resources, it can be labor, it can be capital, right? So when he is talking about resources, that means they are talking about, it can be labor, it can be capital, any resources. The exchange of resources, the exchange of goods, the exchange of services between the countries, right? So between the different countries, when there is exchange of goods, services and resources, that is when we say there is international trade. So it involves the transaction between the residents of the different countries and trading with the multiple currencies. Obviously, every country is having its own currency. So there will be multiple currencies involved in the international transaction. Let's say you are in India and you want to exchange the goods and services with a person in USA. So two currencies, the Indian rupee and the US dollar, two currencies will be involved, right? Greater complexity than the domestic trade. Obviously, sir, when you are going across the boundaries, there will be complexity in the transactions, right? What can be the types of complexities? The paperwork will be more, right? Sending the goods will be a task. Then receiving the money, or if you are receiving the goods, then payment of money across the countries will be a task, isn't it? So there is greater complexity in the transactions, in the international trade transactions, but at the same time, the economies cannot work if there is no international trade, right? So every economy has to depend upon somewhat on the international trade, because in reality, if we talk about, it is not possible for a single economy to manufacture, to produce everything, to provide every kind of services that its citizens want, right? And so there is definitely a need for some kind of international trade, whether it is for the raw material input, whether it is for the resources, the labor, capital, any kind of services that you might need from the outside. For example, a very simple example, sir. India has taken the Rafale jets from Russia, isn't it? So it is not like that India cannot manufacture the fighter jets, but obviously there will be some constraints relating to the resources available, relating to the manpower, relating to the technology, right? So obviously there is a need for international trade. Clear? That is why India is purchasing the fighter jets from Russia. Clear? But obviously there is a lot of complexity involved in the international trade in comparison to the domestic trade. So after that, it is given international trade versus domestic trade, meaning the exchange of goods and services or the resources, the exchange of goods and services, resources between the different countries, and here the exchange of goods and services within the domestic territory of a country, from one state to another state, from one city to another city, but within the territory of a country. Person, transaction between the residents of the different countries, and here the transaction between the residents of the same country. Obviously, two or more currencies are involved, only one currency is involved, that is the local currency, sir. If you are transacting within India, obviously all the transactions will be done in INR, right? It is not like that in one particular state, let's say the person is using the INR, in another state the person is using the US dollar, in another state the person is using the Canadian dollar, in another state the person is using the Australian dollar. That is not possible, right? Now, when you are transacting within the domestic territory of a country, all the transactions will be done in one currency only. Whereas if you are going across the nations for the transactions, then the multiple currencies will be involved, right? Okay. Regulation, this involves the multiple legal systems, detailed documentation, procedural formalities, trade barriers, shipping and transportation issues, all that things. That is why they say that in case of international transactions, in case of international trade, the complexity of the transactions will increase because there will be a lot of paperwork. Why paperwork will increase, sir? Because you will have to follow the legal system of two countries now. Let's say you want to send the goods from India to USA. Right, then you should be knowing what are the legal compliances in India. You should be knowing what are the legal compliances in USA, so that when your material reaches USA, you should not be facing any issues, right? So there will be more paperwork, the custom paperwork will be there, and all those things will be there, right? And if you have to send any goods within the domestic territory, it's pretty simple, sir. Very simple. This involves the law of only one country and less documentation and procedural formalities. There are hardly any procedural formalities and documentation, right? Tariff. The custom tariff is applicable. Obviously, the customs are applicable, and domestic tariff or regulations are applicable. Like we can say the GST is applicable, right? Or OCTRA is applicable. So all these things are applicable when you are sending the goods, or when there is exchange of goods and services within the domestic territory of a country, right? And if you are going across the nation, then you will have to pay the customs duty on that, right? You must be studying the customs duty, isn't it? So that is all is there, right? So international trade and the domestic trade. Now, we say that, okay, it is important for any economy. It is important for any economy. The international trade is definitely important for any economy. But at the same time, there are advantages as well as there are disadvantages of the international trade, right? It is not that we can say that international trade is always going to be advantageous for a nation. It can be advantageous, it can be non-advantageous also. Clear? So he says, what are the arguments in favor of the international trade? That what are the various thought processes where we say that international trade helps in the growth of the nations, right? Cost efficiency. Due to the increased global competition, the domestic producers need to enhance their efficiency and profitability by adopting the cost reduction practices. He says, let's say there is Apple iPhone, right? There is a domestic manufacturer also, and you can import it also. Let's say. So what happens, sir? If you buy it from the domestic manufacturer, the local manufacturer, he's selling you for 80,000 rupees, and you import. If you import it, right? If you import that phone, which is easily importable, let's say, so you will be getting it for around, let's say, 70,000. So what is preferable? Sir, obviously to import it. So what is there, sir? In the local market, the competition is increasing due to the access to the global markets. So the domestic producer will also have to find out the ways to cut down the cost so that it is comparable with the global market, it is competitive with the global market. Otherwise, what will happen, sir? The local people, the local manufacturers, they will be finished. So after that, economies of scale. A wider international market makes the firms enlarge their production capabilities and benefit from the economies of the large scale production. That yes, if the domestic demand for a particular product is, let's say, 10,000 units, and that factory has a capacity of manufacturing 50,000 units, so what they can do is they can export the remaining units if they have the access to the global market, that there is international trade. That is why they have this access, right? Otherwise, they might not be having this access, right? Increased competition reduces the chances of domestic monopolies and is beneficial for the public. Obviously, the domestic monopolies will be very less, right? And because when you get access to the global market, today you are sitting at your home and you can buy anything from around the globe, right? You can buy anything from USA, you can buy anything from Europe, you can buy anything from Canada. You can easily accessible. The global markets are easily accessible. So these domestic players, these domestic manufacturers, the monopolies of that is not really possible. But yes, in some of the products which are not globally accessible, there can be monopolies. not in every product, but it reduces the chances, right? We are not saying it is eliminating. We say it reduces the chances of domestic monopolies. Right, sir. Then optimal resource utilization. The international trade leads to efficient deployment of the productive resources. Obviously, sir, if you have excess resources, you can give those resources to another country, which can lead to the optimum utilization of resources instead of wasting those resources. Clear? Then material, the raw material and other components can be obtained at a competitive prices from the global market. So if you need a raw material which is not available in your own country, you can buy it from the global market. Right, that is another benefit of the international trade. After that, labor. Due to the mobility of the labor across the countries, the firms can enjoy the quantitative and the qualitative benefits of the effective division of labor. That if you have excess labor here, you can send it to some another country, or if you have the shortage of the labor, you need more people to work on, you can ask your friend country to send some people to work here, right? You will obviously you will pay for that, but what is happening is the exchange of labor across the nations, which will help all the nations, right? Even the nation one is receiving the labor services and the nation who is sending the labor services, right? How, sir? Let's say you want to manufacture a product which requires a special skill. In your country, there is no person who is having that special skill. So what you will do, you will ask another country, let's say you ask USA to send some of their great minds having that special skill to manufacture the product, right? So what will you do? You will ask that person to come to India. So there is exchange of labor. The India will get benefited, and at the same time, when India will pay to those persons, ultimately their economy will also grow. They will take the money from India and they will go back to USA, and their economy will also equally grow, right? After that, price stability. The firms can sell their surplus output in the global market, thus preventing the fall in the domestic prices due to overproduction. So if there is any overproduction, they can sell it in the global markets, right? Leading to price stabilization. Otherwise, what will happen, sir? If the local manufacturer, if the domestic manufacturer had lots of product they manufactured, but there was no demand for it, they could not sell it, then what will happen? They have the overproduction. They will have to drop their prices so that whatever is available, they want to clear that stock, right? And if they have access to the global market, they can sell it in the global market and recover their cost. Simple. Innovation. The international trade encourages the innovation by facilitating the exchange of know-how, technology, and investment in the research and development. That is what the example I gave you, that if you want to manufacture a particular product which requires a skilled labor, right, a very skilled person that is required, you ask that person to come from USA, share their technology, share their know-how, and that is what is actually happening around the globe right now, isn't it? So service sector, the international trade has contributed immensely to the growth of service sector. Obviously, sir, today sitting in India, I can provide the services to any person sitting in USA. I can provide the IT services to any person sitting in the Europe, right? So anywhere in the world, I can provide the IT services, and I have experienced that. I have a personal experience relating to that. My father has an IT firm, and we have someone who is otherwise in India. He is having a business in, I think it was Iraq. They were having the business in Iraq, and they were also having the business in South Africa. So we were providing the IT services there also, sitting in India only, right? Sitting at our own city only. We are providing the IT services in South Africa, in Iraq, and the different countries. In Dubai also, one of our clients is having the offices in Dubai. We are providing the services in Dubai also, right? So the service, this international trade has immensely contributed in the growth of the service sector. Wider access. The global markets provide the consumers with access to a wider variety of goods and services. Obviously, sir, now you have access to the global market. You have lots and lots of things in front of you, right? You can choose as per your preference. You can buy as per your preference. Now there is no limitation as to, okay, this is the only choice, you have to buy it from it. No, now this is the only choice and you can buy it from anywhere in the world, anything that you want, isn't it? So that is what the wider access to the global markets promote the harmony and cooperation. The international trade strengthen the ties between the nations by bringing people together in peaceful and mutually beneficial exchanges. Obviously, it is beneficial in the sense that the two countries are exchanging the goods and services. Both are getting benefited from it. So there will be harmony, there will be good ties, right? There will be meetings, there will be exchanges. So all this will help in the growth of both the nations, right? So these were the arguments in favor of the international trade, that how the international trade help the various nations in the growth, in the exchange of know-how, technology, resources, in whatever way, right? How both the nations can get benefited. Now, he says there are some arguments which are against the international trade, right? Arguments against the favor of international trade. Harmful goods. Harmful goods. They say the unwanted and the harmful goods may be imported into the country when the international trade increases, right? Some unwanted goods, harmful goods which are not good for one nation, it can be imported by the people, right? Loss of cultural identity. Too much import lead to the loss of cultural identity and the adoption of more foreign consumption practices. So this has actually happened, sir. This has actually happened. Earlier, let's say you want to make a t-shirt, right? The cloth of that t-shirt, I can say the earlier, some local artisans were there, some local people were there who used to make that cloth with the old technologies. Now, with the introduction of the international trade, with the access to the global market, what the people are doing these days? The people ignore our own people, right? The cultural practices, the old age practices, which were done, they are leaving that and they get easy access to the global market. They buy from there, which might be 2 or 3 rupees cheap. But what you are doing is you are losing your cultural identity. You are losing the identity of your own culture, of your own country, with the wider access to the global markets, right? This is definitely, and this is one of the practical, I can say, the points. This is actually happening, sir. The balance of payment deficit, if the country imports more, it may lead to the balance of payment deficit, that if you are you have easy access to the global market, you might be importing lot of things, right? Instead of your more of your exports, you might be importing the raw material more, which may lead to, now if you are importing from another country, you will have to pay to that country, right? So your balance of payment deficit means that what you will be receiving from the exports is less, what you have to make payment for the imports is more. That is what is balance of payment. Let's say, let's take an example that you are importing goods worth rupees $100, right? And your export is worth rupees $50 only. Now what will happen, sir? In case of imports, you have to pay money, and in case of exports, you will receive money, right? Your receipts are less than the payments. Your payments are more than the receipts. Now in this case, what will happen, sir? This is a case where we say that BOP deficit, that is balance of payment deficit. Now this is not good for an economy. If you have a negative balance of payment, if you have the BOP deficit, then it is definitely not good for the nation, right? So rivalry, the trade may cause rivalry among the nations due to the existence of the sphere competition, right? Obviously, on one hand, if we say that the two nations can be good friends with the international trade, at the same time, if they are manufacturing the same product, then there can be fight also in terms of prices, in terms of quantities. There can be rigorous fight between the two countries. Fight not in terms that they will, take the guns and fight. No, in terms of the trade fights, right? So which can, create some distances in the relationships that can affect the relations between the two nations. Threat to domestic industry, the international trade threatens the local infant industries through stiff competition. Obviously, the local industries might lose out on the cost basis, right? The cost of the product might be high, and the foreign cost of the same product might be little less. But at the same time, so that is where they beat the domestic industries. But at the same time, how the nation is losing is the nation is losing its cultural identity by going to the foreign, which might be comparatively cheaper, right? We are going for the Chinese product these days, which are comparatively cheaper. But at a later stage, we might know that the quality is not that good, right? The domestic people might be manufacturing the same product with a higher cost, but with a better quality, right? Okay, after that is price fluctuation. The international price fluctuations may lead to loss of revenue for the exporting country. Obviously, sir, when we say that there is a change in the dollar prices in comparison to the rupee prices, every day it is fluctuating, then it will lead to losses. Shortages, the excessive export lead to shortage of commodities in the local market, leading to inflation, social unrest, etc. If you are exporting everything outside the country, then who will be fulfilling the demand of the people within the country? Obviously, the demand is high, the availability is less, it will lead to high prices, it will lead to inflation, it will affect your country. The loss of sovereignty, the substantial dependence of the underdeveloped countries on the foreign nations had adverse impact on their economic and political sovereignty, individuality, their own identity, because the underdeveloped nations have to depend upon the developed nations for the various things, but that is severely impacting their individuality. Global warming, it is one of the indirect effects of higher volumes of international trade. Yes, there is international trade, and because of that, the global warming is increasing. Lack of transparency. The lack of transparency between the trade partners or the trading countries defeat the purpose of international trade, that if they are not transparent in their terms and conditions, that on what terms and conditions they want to trade and all those things, if there is no transparency between, see, what you are doing is, in the international trade, most of the times what you are doing is, you are not going physically to that location to see the things and have a face-to-face talk with the person, the multiple talks. No, sir. You are calling over the phone, you are talking over the emails, you are talking over the WhatsApp, right? So that is what is happening. So in that case, there can be the lack of transparency in terms of terms and conditions and all those things, which can definitely negatively impact you. So these were some of the arguments in favor and some of the arguments against. But yes, at the end, we can say that all the countries need to have the international trade, but carefully keeping in mind what are the negative impacts, what can be the negative impacts on the economy, what are the positive impacts on the economy, and focusing more on the positive impacts, that we need to increase the positive impacts rather than the negative impacts, right? Okay, after that, what we have is the theories of international trade. Now, the different theories were given by different people, and there were different views related to that, how the countries are conducting the international trade in between. What are the various bases? What is the thought process behind the international trade when countries exchange goods and services with one another? Now, these theories are very, very, very important, right? One or two theories can be definitely asked in the examination from the international trade. So the first theory is the mercantilist approach, one of the oldest approaches, right? Not that much applicable in the today's scenario, not applicable in the today's scenario, right? So in the 17th and the 18th century, see, that old it is. The international trade has been that old. We can't say that it is a very new phenomena. No, sir. The international trade is being conducted since the ages, and that is when the 17th and the 18th century this mercantilist approach came into play. The policy of mercantilism was adopted by many nations, right? This approach advocated that a country can grow richer and prosperous by accumulating the gold and other precious metals, and hence required a country to export more and get gold, silver and other precious metals in return thereof. So basically, in as per the mercantilist approach, how the international trade was being conducted, let's say there is country A, right, and there is country B. Now country B wants some wheat, right? And country A is a surplus manufacturer of wheat. Listen to it very carefully. Very simple approach. What he says, there are two countries, country A and country B. Country A is a surplus manufacturer of wheat and country B needs wheat. Now, what will country A do? Country A will export wheat. They will export wheat, but in return they will not be getting the money. So what they will be getting in return is, the country B will give to country A what? Gold and other precious metals. Other precious metals. So that is what this approach is saying, that a particular country can grow rich by accumulating the gold and other precious metals. Which country is growing rich here? Country A is growing rich here by accumulating the gold and other precious metals. But for that, the country A will have to export more. The more it exports, the more it will get the gold and other precious metals, the more it will get richer, right? it advocated the maximum exports and minimum imports. Because why minimum imports, sir? Because in case of imports, then this country will have to give the gold and precious metal, right? If they are importing something, they will have to give the precious metals and the gold. Then other country will be getting richer. By imposing the heavy import tariffs, how they can reduce the imports? They put lot of import duty so that people are discouraged for imports and there are relaxation for the exports. It argued that the trade is a zero-sum game and no win-win situation is one country. It is not a win-win situation for both the countries. Why, sir? Because one country will gain more and another country is losing the gold and precious metals, as one country can grow at the expense or the detriment of another, right? So what this approach is saying, that one country is growing at the expense of another country. Now in this case, the country A will get richer, this country will get richer, but at the expense of country B. At the expense of country B, they are getting the richer. So one country is at a disadvantage and another country is at an advantage, right? So it is not a win-win situation. Win-win, when it is a win-win situation, the win-win situation is when both the countries are at advantage. Here, country B is getting wheat, but at the same time, they are losing gold and other precious metals, which is more precious than the wheat to the country, right? So country B is not getting richer. Country A is getting hugely richer by doing the simple exports of wheat. Clear? So this was a very simple approach, the mercantilist approach. And yes, sir, if it is not practically applicable in the real world, can it be asked in the examination? Yes, why not? Right? That is why it is in your syllabus. It can be asked in the examination. So please do not be in that dilemma that, sir, whether this approach, it was 17th and 18th century approach, sir, we are in the 21st century. Can it be asked in the examination? Yes, sir. It can be asked in the examination. The institute wants that you should have a complete knowledge, the comprehensive knowledge of each and everything, right? Okay, so the rest of the approaches will continue it in the next lecture. The next are some of the approaches are very, very, very important, right? Theory of absolute advantage is there. Then very important, sir. Theory of comparative advantage, then theory of comparative advantage with opportunity cost is there, right? So these theories are very, very important. These are simple, sir. We'll try to understand with the help of an example. Then Heckscher-Ohlin theory is there. The factor endowment theory, which we call it as, right? Then new trade theory, chapter finish, right? So maximum two more lectures, because these theories will take some time. The theory of absolute advantage, I'll try to explain it with the help of examples in a very simple way, right? In which you people will be able to understand, right? But for that, one thing is very important. You must be having the books, which you can buy it from our website, ksjteaching.org. A small investment, a small contribution to the growth of this channel, right? In the forms of the book that you can buy from ksjteaching.org exclusively from our website only. And another contribution that you can do is subscribe to the channel, press the bell icon so that you get all the notifications, and share with all your friends. Hit the like button on the video also, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.